Welcome to this webcast about the retrospective assessment and accounting for unexpected change in the current net open risk position when using the DRM model. This is webcast 6 out of 8. This webcast is separate to the general overview webcast and focuses on how the retrospective assessment shall be applied at the end of each DRM assessment period and how the effect of unexpected change would be captured. The prospective assessment discussed earlier ensures that the risk mitigation intention would only mitigate the organic risk in an entity's current net open risk position and helps the entity to achieve its target profile at the beginning of the DRM assessment period. During the assessment period, there may be unexpected change to the entity's current net open risk position. Retrospective assessments are introduced into the DRM model in order to capture the effect of such unexpected changes. At the end of each DRM assessment period, the entity is expected to assess whether A, the entity has mitigated the interest rate risk, and B, the target profile has been achieved. Although this seems similar to the prospective assessment, the retrospective assessment is based on the current net open risk position at the end of the period, and hence include the effect of unexpected change during the assessment period to the underlying positions that forms the current net open risk position. For example, if the current net open risk position includes risk exposures from expected cash flows, the effect of any change to such cash flow expectation would be captured in this process.
It's worth noting that the retrospective assessment is still a risk assessment and does not involve measurement directly. This is different to the retrospective assessment under the IAS 39 hedge accounting model, where the focus is on the measurement where the changes in fair value on the hedged items is compared with that of the hedging instruments. The right-hand side of the slide shows two typical examples when unexpected changes lead to breaches to the retrospective assessments. In the first example, a decrease in the current net open risk position caused overhedging during the assessment period, while in the second example, an increase in the current net open risk position caused the entity to be outside of its target profile. In both cases, the entity will be required to capture the effect of unexpected changes to the extent that would rectify the breaches. The entity is then required to also include the changes in the fair value caused by this effect of unexpected changes when calculating the DRM adjustment. The IASB does not prescribe particular methods an entity shall adopt to measure such effect, although one of the possible ways is to construct some additional hypothetical derivatives in a similar way as the benchmark derivatives and use them as a mathematical expedient for measurement.
Thank you for explaining these DRM elements. We understand the objective is to enable entities to better reflect their strategies and activities, and that's why the IASB made some further refinements to better represent the risk management views and activities in the DRM model. But could you also elaborate how does that balance with the discipline and the robustness in the DRM model?
That's a very good question. While we try to closely reflect the risk views by amending the target profile, introducing the risk mitigation intention, etc., we would also like to highlight the inherent disciplines in the DRM model to ensure accounting robustness. Firstly, the DRM model is based on the net risk views, as entities are required to calculate the current net open risk position as the starting point for applying the DRM model, or in other words, the available risk capacity to hedge. This ensures the DRM model conveys the holistic view applied during the dynamic risk management process consistent with the risk management views and thus provide direct insight to an entity's risk management activities. More importantly, together with the prospective assessment requirement, a net risk view also ensures that only derivatives that are genuinely mitigating the net open risks are benefiting from the accounting exceptions allowed under the DRM model. For example, if an entity holds asset with total risk of, say, plus 100 PV1 and liabilities with total risk of, say, minus 80 PV1, that is the present value for every 1 basis point shift in interest rate, the maximum of risk in derivatives that would be benefit from the DRM accounting exception would be minus 20 PV1. This compares to the possibility of designating derivatives with risk of up to minus 100 PV1 against assets or up to plus 80 against liabilities under the existing hedge accounting models, which will reduce the inconsistency between risk management and accounting. Thirdly, although the DRM model allows the entity to choose the risk mitigation intention freely at the beginning of each DRM assessment period, it also requires such intention to be evidenced by some real actions taken in the market, such as trading an external derivative. This helps to ensure the risk mitigation intention cannot be artificially set purely for accounting purposes to achieve specific accounting outcomes. In addition, the introduction of the retrospective assessment also ensures that the effects of unexpected changes would be captured when the cause breaches. These are important since the DRM model allows the inclusion of expected cash flows.